It's now time for us to go through a deferred tax exercise that's going to really help explain what the accounting is for deferred taxes. So let's go through a simple exercise. Here we have a company that buys a $30 machine, property, plant, and equipment with a useful life of 3 years. For book purposes, we're going to assume straight line depreciation for this machine, but for tax purposes, which requires an accelerated depreciation method, which the IRS dictates that we use a double declining balance, a specific type of double declining balance accelerated approach called MAKERS. For the purposes of this simple exercise, let's assume that MAKERS wants 50% in the first year, 33% in the second year, and 17% in the third year in terms of depreciation. That's not exactly how MAKERS is, but it's close in terms of the acceleration. We just wanted to keep the numbers simple for the exercise. So what we also see here is a very simple income statement for the next 3 years with cash revenues and cash expenses. And so from a tax standpoint, there's no difference. Both the IRS and US GAAP recognize the cash revenues and the cash expenses the exact same way every one of these 3 years. So we see the two sets of books here. But then obviously for book purposes, you're going to have different depreciation recognition than you're going to have for tax purposes. And the results of that will lead to divergences in net income for both book and tax purposes. Now, I want you to only focus on the balance sheet for book purposes. We don't really care so much about the balance sheet for tax purposes for this exercise. And I want you to take a stab at what happens because of these divergences. How is the difference between depreciation recognized for book purposes versus tax purposes going to be recognized on the balance sheet? So give this a shot. This is a challenging exercise. Revert back to some of the prior pages to understand how the treatments work. If you're struggling with it, hit on pause and we're going to go through it together. It'll get easier once we go through this first exercise. But if you want to give it a shot yourself. Hit the pause button and then hit on pause and we'll go through it together. So first we're going to complete the income statement for under book purposes. A $30 machine with a useful life of 3 years is going to have depreciation every year of 10, 10, and 10. Now what that means for pre-tax income is that every year we're going to have 40 in pre-tax income. At a tax rate of 40%, we're going to have taxes of 16. Leading to net income of 24, 24, 24. Now, the tax accounting is a little bit different. We're going to have depreciation in the first year at a 50% depreciation rate on a $30 machine. That's depreciation of 15. Then we're going to have depreciation of 33% on a $30 machine. That's 10. And then we're going to have the final year's depreciation is only 16 2/3 or 17%. We rounded off here, roughly 5. So notice that the same $30 worth of depreciation is happening, just the timing of it is a little bit different. But what it leads to are different results for pre-tax income for every year. So pre-tax income in the first year was 35, lower than the book or reported pre-tax income. The next year it's the same. And then in the final year it's 45. It's actually going to be higher. The fact that you're recognizing higher depreciation in the first year is reversed in the last year, leading to now higher pre-tax income. So that the actual taxes, the actual current tax payable is 50 minus 15, this $35 pre-tax income at a 40% tax rate. We're looking at 14 in actual taxes that are due that year as opposed to the 16 that are reported. And that's the crux of it. Understand that under GAAP, looking at this year based on GAAP rules, they're arriving at a tax expense of $16, whereas the government is saying you only owe us 14. But of course, we know that the difference is arising from something temporary. The next year, we're going to have the same liability for book and tax. It's the same pre-tax income as for book and tax purposes. But then it's in this last year that the difference is reversed. It's in this last year that the IRS says, oh, you owe us 18, not the 16 that we recognize for book purposes. And it simply has to do with this timing difference of when depreciation is taken. And so we can complete the steps here and realize that net income in this year is 35 minus 14, or 21. 40 minus 16 is 24. And then in the last year, 45 minus 18 is 27. Okay, so we have different net incomes now. And now we turn to the balance sheet. And this is where hopefully it becomes clear why we recognize a deferred tax liability. So let's start with the easy stuff. The easy stuff is, we had debt. Nothing has changed with debt. So let's fill that out as 20. We didn't identify any changes to the debt balances. We didn't identify any changes to inventory balances. So we're going to put in 20 across the board. I'm just getting rid of the easy stuff first. Property, plant, equipment, what's happened is that every year it declines. And this is for book purposes, so it's declining from 30 to 20. It's a useful life of 3 years on a straight line basis because this is the book balance sheet. And now we fully cycle through that PP&E. We don't know what's going on with cash yet. We have to actually sort of build an on-the-fly cash flow statement to figure that out. Now, common equity is actually also a fairly straightforward line item. What makes equity go up from one year to the next? It's retained earnings. It's net income on the retained earnings side. That's the only thing that's changing. And so we went from a total equity balance of 30 to 54. Notice we're not taking the tax accounting income statement to grow our retained earnings. Our retained earnings grow, or equity grows, by GAAP net income. So let's add another 24 so we get to 78. Last but not least, we get to 102, 78 plus the final year's 24. And now we have the basis for sort of figuring out what else needs to be done. So let's figure out what's going on with cash. How much cash went in my pocket this year in 2015? I had cash revenues of 100, cash expenses of 50. That means $50 of cash the company generated in profit. Was there any other cash outflow during the year? Well, don't be fooled. It's not being reflected here. It's actually being reflected here. The only other cash item was the tax liability that the IRS says you owe. But it's not the 16 that we show on our GAAP-based financials. It's the 14 that we're going to pay to the IRS. Now, notice as investors, we don't really see these tax returns. All we see is this, right? But in reality, because for the purposes of this example, we're seeing the tax return, it's abundantly clear that the actual cash impact is 50 minus 14 in the first year, or 36. So there's an increase of cash of 36. In the next year, there's an increase of cash of 50 minus 16, of 34. We started with 36, so now we're looking at 70 in cash. And last but not least, 50 in operating profits minus a tax payable to the IRS of 18 gets us another 32 to 102. So now the only line left is the thing that plugs book and tax accounting. And in this case, what ends up happening is if we add all these up, we get 76 in total assets. And then we get 100 in total assets. Right? We're just summing up all of these. And then lastly, 102 plus 20 is 122. Now at this point, I have total assets. Let's focus on 2015. I have total assets of 76 and liabilities and equity of 74. My balance sheet is out of whack by 2. Right? 74 is liabilities plus equity. If you add these two together, and you have total assets of 76. I'm off by 2. The plug, the thing that makes a balance sheet work, is now the creation of a deferred tax liability. And the deferred tax liability starts at 2, and it recognizes the fact that in this year, we paid less to the IRS. The way to think about it conceptually is that in this year, because of a temporary timing difference, we paid less to the IRS than we are presenting that we owe for book purposes. And that means that from a book purposes standpoint, because it's a temporary timing difference, we recognize the 16 book purposes tax expense, but we also recognize that there's a liability that going forward, because we did not actually pay our full expense, at some point down the road, we are going to owe an extra 2 to the IRS than we are going to show. And let's see how that plays out. In the next year, there's no reversal. We're paying the exact 16 that we think that we owe for book purposes, and so the deferred tax liability stays at 2 on the balance sheet. But in the final year, when we show that we owe 16 in taxes, but we pay 18 to the IRS, that's due to the reversal. That's due to the reversal of this temporary timing differences associated with depreciation, that the deferred tax liability goes down to zero. The net result is that our balance sheet is in balance. We have total liabilities of 22, and then 20. If you add that to equity, we get 76, which exactly equals our assets. And this year we take 22 plus 78, which is 100, which exactly equals our assets. And then we take 102 plus 20, 122, which exactly equals our assets. So this is the way to calculate deferred tax liabilities. This is the accounting associated with deferred tax liabilities.